But one of the things that I look for is the psychology of the investing public. And everyone out there, the talking heads, the average investors, everyone has been telling me there's going to be a Christmas rally. And if there's one thing I've learned in my career, it's that when everyone says something, it's usually potentially it's going to be the opposite. Oh, right. I mean, the Federal Reserve, I've gone on record for years now saying that they are the culprit for basically every bubble that we see, right? So in the 90s into 2000s, we saw the collapse of the dot-coms. They came out, they lowered rates, they made lending easy, which created the housing bubble. Then we saw that collapse. Then they came out with even more guns blazing and created this massive flood of liquidity, which we now have this bigger bubble. And every time they do this, it's a bigger and bigger bubble, which is bad because then you get a bigger collapse with that. And the psychology of a day trader has to be much firmer because you're basically trading these massive moves on an intraday basis. You know, you're shorting the stock that's up 10 or 20% into a pivot high, and it takes some guts to pull the trigger, even when the charts are in your favor. And you have to also realize that the average investor has put more money in the last year in the markets than they did in the past 20 years combined. Mm-hmm. And that is like a freight train just coming through. Even if institutions are unloading a little bit, it's enough money to keep the market going up. Now,
welcome back to Risk. My name is Lee, and I have a special guest with me, Mr. Gareth Soloway. Gareth, it's great to see you again and speak with you. Why don't you tell the audience who you are, where you're from, what you do?
Sure. So great to be here, Lee. Thank you so much for having me. My name again, Gareth Soloway. I'm a swing trader and day trader. Those are my fortes, generally in stocks. I've been doing it since really about the late 90s, early 2000s. I first got introduced to trading in the dot-com era, for those of you that remember that, and the craziness of that. And I was a real young kid, high school, kind of just, learning about the stock market. And it was addicting to watch these stocks go up, kind of like what we're seeing in cryptocurrencies these days, or some of the, the EV stocks. It was very addicting to think, even though it was at that point in my career, I didn't have any money. So it was kind of just playing these stock market games, but it was addicting, to watch the money multiply that quickly. And I said, I got to do that. And I went ahead and went to college. And after college, I basically started trading and trying to figure it out on my own. It didn't go great at first. Trading is very hard. A lot of discipline is required. But over time, I was able to slowly understand the charts and get better and better. And in 2007, I started InTheMoneyStocks.com with a couple of business partners. And here we are in 2021. So
the market has certainly evolved since the internet days. I was actually actively trading back then as well. I was trading next to 20-something-year-old guys, and they'd throw on size, and JDS Uniphase would rip. They'd make a lot of money. And then, September 11 came, decimalization came, the market really shifted and changed back then. Yeah. What evolution have you seen in your professional career since you got into it?
Yeah, so exactly what you're talking about. I still remember JDS Uniphase, Sycamore Networks, Nortel, all those fun ones. Yeah, back in the day. But yeah, I think the decimalization definitely brought those spreads tighter. I think a lot of the changes that have occurred have made it much easier for just your average investor to get involved and trade on their own. I mean, if you go back to even prior to me, there was really, you have to have a broker. No broker was going to touch you if you only had $1,000. They wanted legitimate commissions that were pretty sizable. So it really was for a more rich clientele to get involved in investing and trading. And now you have, people are trading for free with no commissions. The spreads are so tight that you're really just paying a penny difference from the bid and the ask. And I think the speed of things has really increased as well. Everyone has a platform now with charting on it, with all these indicators. Back then that was, hard to find for sure, and cost a lot of money.
No doubt about it. You really need a professional organization behind you to be a successful trader. So tell me a little bit about your trading style. You mentioned swing trading and day trading. They're just really basically trading in different time frames, but there are some differences between them. Why don't you tell the audience what you think they are?
Yeah, so day trading is much smaller time frame. It's intraday. So when I day trade with my traders, I'm getting in and out within minutes. Maybe I'll hold for an hour or two, but in general, if the trade plays out correctly, you get a quick bounce. We're focusing on counter trend moves. So for instance, a stock might be down 20% on the day. What I do is I'll go look at the chart. Every decision I make is based on charts, right? So I'll be looking for double bottoms, for gap fills, specific technical reasons why when a stock drops into that level, it's going to get a quick bounce. And for a day trader, you buy size. So you're buying, a fair amount, and you're just looking for a quick bounce in those scenarios where you're making, $500 a pop or $1,000 a pop or whatever it is, but you're not sticking around. You just get in, you get out. And that really is what day trading is. For swing trading, the same ideas apply in terms of charting. So I'm looking at pivot highs, pivot lows, gap fills, trend lines, but the period expands. So I'm looking for a bigger gain over multiple days or weeks. And again, you can find that in charts amazingly. I mean, charts have really revolutionized how I've been able to trade. It's basically charts give you the ability to be the casino versus the gambler, right? So the gambler walks into a casino. Yeah, sometimes the gambler will walk out with more money, but the casino knows that they're generally going to make money. You want to be that person. You want to be the house essentially of the casino where, yeah, you'll lose a trade here or there, but overall you make money consistently. And that's what the charts gave you the ability to do, is have the probabilities in your favor.
Do you find day trading more challenging than swing trading, or vice versa?
Oh, wow, that's tricky. So there are kind of like both sides of the coin, right? So what I love about day trading is that it's in and out and you're back in cash. So yes, it's tricky because a stock may not behave perfectly well right in that small time frame, but if your charting is correct, it should, and you go right back to cash. So at the end of the day, you go to sleep like a baby, right? You're in cash. You don't have to worry if China does something overnight. You don't have to worry if, the world essentially ends. You're in cash. Swing trading, you get more time where you're not worried about the very small upticks or downticks, but at the same time, you're opening yourself up to risk of, a bear market. What if the Fed says something here? What if, there's so many what ifs that can affect the market on the next day or even during that hold period. So I think there's positives and negatives to both of them.
Do you have psychological challenges greater with one other than the other?
Yeah, I think in general, the psychology of a day trader has to be much firmer because you're basically trading these massive moves on an intraday basis. You're shorting the stock that's up 10 or 20% into a pivot high, and it takes some guts to pull the trigger even when the charts are in your favor. Same thing with the downside where these stocks are collapsing and you're going counter trend. So you're saying this is down 25% on the day, but I think right at this specific penny, it's going to bounce 30 cents and I can be in and out with 1,000 shares for $300. So it takes a lot of kind of discipline and kind of calm and patience versus swing trading. I think you can kind of sit back, and if it doesn't bounce and if you're out of the money for a little while, as long as your longer term thesis holds up, you can kind of say, okay, it didn't work out right away, but I still like the factors for why I bought, and I'm going to give it some room to breathe.
How much do market conditions play in your strategy?
Yeah, so market conditions definitely dictate the strategy, both on the swing trade and the day trade side, in that if you're in a bull market, whether you're swing trading or day trading, you're going to look to buy pullbacks. So in general, during this market that we've been in, where we've been going to all-time highs, I'm shorting specific indexes and big stocks at key levels. But a lot of times I'm looking to buy pullbacks, especially even in the day trading world, because there's so many buy the dippers that are just coming in and kind of boosting that right back up. It means that the wind is at your sails, behind you, pushing you. You don't really want to fight the trend, they say. And that does apply somewhat, even though I do occasionally go short the market and the equities.
What do you think of the current marketplace right now? I mean, is there a particular sector that you're involved in? Are you trading crypto? I know you touched precious metals, obviously.
Mm-hmm. Yeah. So I definitely do a little dabbling in crypto as well as in precious metals. I'm a huge long-term fan of gold right now. Long-term, if you talk 5-10 years out, I really like cryptocurrency as well. But crypto, again, there's too much speculation in it. You traded back in the dot-coms. We all remember what happened to the dot-coms. I do worry that you're going to have a flush out of a lot of the dot-coms where they drop 80-90%, and then the strong will survive. The Bitcoins will survive longer term. So I'm very hesitant to be long the cryptos right now, except for quick trades. With stocks, it's just kind of looking at the market. I think the market is ridiculously valued at these points historically. So I'm more apt to be short the S&P and the NASDAQ. In fact, I am right now. But at the same time, I'm long certain areas like the Chinese stocks. Their current valuation, it's really, I'm a technical trader, but I like to have at least the belief that there's some fundamental value there as well.
Yeah,
And I
of
mean, I was
course.
just commenting today, Costco's trading at a ridiculous level. It's like at a 42 forward PE. And I'm trying to sit here and figure out why that makes sense for a retailer to be trading at a high tech valuation. I mean, and again, the market is going to give these things valuations, but it has to make sense to me. So in fact, I'm short Costco right now, believe it or not.
Are you short just because of the PE, or clearly there must be some technical chart reasons?
Yeah, absolutely. So there's trend lines and so the stock, just to give you a sense, is just going back to this year, it was trading at, and I'm looking at my charts here, at about $300 a share. And that was just in March of 2021. So, 7, 8 months ago, 9 months ago now. But now we're at $550 a share. It's extremely extended on all signals out there, including the chart. So yeah, there's definitely chart factors there that are making it, plus the valuation.
Do you have any favorite indicators that you look at?
I do pay attention to like RSI. RSI, it's not a good thing to just base a specific entry on. But if I have technical indicators, like for instance, on CHGG right now, the stock has been pounded down, and the RSI has been below 17 for 2 to 3 weeks. Now, anything below 30 is considered extremely oversold. So I look at the chart and it just hit a double bottom in the last couple of days from March of 2020 when the COVID lows hit. And so I kind of base the chart there and I say, okay, the RSI is extremely oversold. Usually charts don't remain this oversold for long periods of time. I'm going to bank on that bounce back swing trade right now.
I'd like to kind of shift gears and get into your evolution as a trader from the beginning, because I'm sure you lost a lot of money in the beginning. I mean, everyone pays tuition to get into this business.
Yeah. So, and you're 100% right. I tell everyone that asks me is you're either going to pay the market for the education or you're going to pay someone that knows what they're doing, and usually paying someone that knows what they're doing is going to be cheaper. I myself lost easily over $500,000 over the course of my early period. And just to keep in mind, when I first started trading on my own, I had $10,000 to my name. I went to a firm that gave me $50,000 to trade off of that. All losses came out of my 10,000. And I actually worked 3 jobs. I was a bartender at night. I was a bartending instructor on the weekends. I mean, I did multiple things because I was so dedicated to learning how to trade. I wasn't going to lose my money and be done. So what I ended up doing is I'd lose a few thousand. I just work my butt off, replenish it, lose more. And I basically, that's how my evolution was. I wish I had someone that taught me how to do certain things, but I just didn't have that. But you absolutely, the market is going to make you pay quite a bit if you don't know what you're doing. There's absolutely no way around it.
Is there something other than getting a mentor that if you're trading on your own, or, kind of like a hobby, you have a full-time job and you want to swing trade, any recommendations you could make as to kind of shorten that learning curve?
Yeah, so I think going on Amazon or some other place and getting a basic technical analysis book is really helpful. It kind of builds that foundation for understanding what you're seeing in the charts, looking at signals like, I mean, in a technical analysis book, you'll see what a topping tail is, what a bottoming tail is, and those can be just very simple reversal signals in a chart that can tell you to get out if you're long, if you're seeing a topping tail, or go short if you're not in and you just want to look on the short side. So I think doing it's basically putting in that time and effort. I mean, you can definitely find great books out there. But again, I wouldn't look for any of the fancy stuff. There are lots of firms that'll sell you this crazy scanning technology. I would really tell you just to go with the basics, learn the basics, build it from the way up. There's no magic cure for great traders out there. It's really learning it and then trading it and learning it on top of the trading.
So things like basic technical patterns, like double bottoms, head and shoulders, cup and handles, like that kind of thing is what you're saying, right?
Yeah, that's really what I trade off of. I trade off of 3 factors: price, pattern, and time, right? So time would be, time of year, for instance. You can look at what are the general trends, time of year. It can be something as it's a little more complex, but it's called time counts. Pattern would be bull flags, bear flags, head and shoulder patterns, which you can find in these books. And then the price point would be like a gap fill or a double top, where price is hitting a specific level where historically you would see reversals off of those levels. And it's really what I found is if you can put 2 of those 3 factors together, you get yourself to about 80% success rate odds on a trade. So a lot of people will just see one thing and they'll say, oh, I'm going to do that trade. And then, they have maybe 60% odds, but you really want to couple them together. And then that's where you get that success rate where you're really going to see the profits emerge.
So you really want to stack the odds in your favor is what you're saying.
Exactly. And there's nothing worse than being in a losing trade. And then the stress and the anxiety and the kind of the ego that you have to deal with. Do you cut it? Do you not? And then we inevitably, as human nature goes, we always cut it at the wrong time. Right. And then as soon as we do, it goes the opposite way. So if you can limit getting in those bad trades, that's where you're going to see the success really go.
So I'm assuming you're much more selective now with your trades than you were early on.
Oh, hugely, hugely. So I mean, back when I first started, I was probably doing like 20, 30 day trades a day. Now I do maybe one, maybe two. And I make so much more money. It's incredible because I'm not getting into bad positions. I'm selecting the right trades based on strict criteria versus just being like, oh, that stock's up a lot, let me short it, or that's down a lot, let me go long, with no basis for that whatsoever. That was my beginning career and why I lost so much.
Are there any books that you'd recommend, specific books?
I wish I had a title. Because I am self-taught a lot of this stuff. I didn't do that in my beginning career. I wish I did. I implore people that are watching to read and use it, educate yourself, just like a brain surgeon or a doctor has to go and spend time studying. We all need to study as well. I just did the opposite road, which took me a lot longer, which was trial and error. But I don't have any specific books that I recommend, but just look for simple technical analysis.
How about your risk management strategies? I mean, apparently you have a very selective system to choose a trade, but what do you do? How do you prevent that trade from going against you too much, and just general risk management protocol, if you will?
So I think the number one thing that has helped me is in my early career, and this goes for most investors, is that when we get into a position, we think we're going to be 100% right and we're going to make $1 million and it's going to be, all great. In reality, you have to be humble enough, and this comes from probably taking enough losses in my early career, where I realized that even as much as I like a level in a stock, it may not be the bottom. And so what I do is I'll go into any trade, and this goes for day trading or swing trading, saying, okay, let's say I'm going to put $100,000 in this trade, but my first entry at the level will probably be like 25,000. And what that does is it gets me involved. So if it does bounce, then I make money. But if it goes lower, I can choose the next level and add, and it gives me multiple abilities to kind of average down as long as my thesis is still in play. And that has given me the ability to make more money because more often than not, stocks do go lower because of fear, right? Panic selling, they drive them lower, and it gets you a better overall average. I think otherwise, in terms of ways to mitigate risk, you have to look at the chart. So for instance, if you have a topping tail, right? So a topping tail is a long tail on the top with a close in the lower portion. It has to occur at the high of a chart. So you have that tail high. If you short that bearish signal, any close above that high of the candle would be telling you it's going to go higher, or at least the probability shift that it's going to go higher. So that would be where you would say, okay, the reason I took this trade is now null and void. Let me exit for a small loss. And you can do things like that with technical analysis where you really isolate those levels and you can say, okay, it changed. Now I'm out.
So in that situation, how do you prevent yourself from talking yourself into staying in that trade?
Well, that's always the battle we face. And, again, a lot of it comes down to ego. And, I struggle with it. I think just like everyone is that, you truly believe that the next day it's going to be, and then the next day and the next day. And you just have to, have kind of a strict criteria and go with it. But again, each person has to find that's within themselves to say, okay, no matter what, I'll cut it. Or, you could always have your significant other, or, like someone who's not as emotionally involved, maybe watching over your shoulder and then saying, you better cut that.
It'd be a rare trader to have someone do that.
I know. True.
So what do you think of the current, just what's going on in the markets? I mean, you said they're tremendously overvalued. You're short, but, traditionally we've kind of gone up this time of year into, the Christmas rally. So.
Yeah. And that's one of the reasons why. So technically, you've hit an upsloping trend line on the Qs as well as the spiders, and that's the technical reason for it. But one of the things that I look for is the psychology of the investing public. And everyone out there, the talking heads, the average investors, everyone has been telling me there's going to be a Christmas rally. And if there's one thing I've learned in my career, it's that when everyone says something, it's usually potentially it's going to be the opposite. The same thing happened with crypto recently with Bitcoin. It got above that 65,000 high. Everyone was like, oh, it's going to go to 100,000. And then, oops, back down to 56, wherever we are right now.
Speaking of that move, I was looking at the RSI and I'm like, yeah, no, this thing is coming down for.
Yeah, for sure. And I mean, I'm on Twitter and, God forbid I post anything, slightly about a pullback in Bitcoin. And like, you could just see the people attacking, right? And I'm like, okay, well, now it's for sure going to go down if, people are this bullish, right? Yeah. So, I mean, there's things like that you can look for. But with the markets, it's kind of the same thing. Everyone's calling for it, so it makes it skeptical. I also reckon back to, 2018, when the Fed began to tighten interest rates for the first time since really 2009, since they dropped them the lows. And the market, as soon as that began, started to sell off. So I say to myself, okay, they're starting to taper now. That's a little bit of tightening. Do we see a repeat of that where and in all fairness, this week we've seen that volatility increase. We've seen some pretty whippy moves in the markets off of their all-time highs.
I've been such a bear since probably springtime, summer.
Yeah.
And boy, have I been wrong.
I mean, I've been generally bearish too. I've just been able to kind of mitigate it with jumping in and jumping out on these pullbacks that we get. But I mean, it's incredible. I think for someone who has, you and I are probably based on technicals and logic and all those things. And then you have to also realize that the average investor has put more money in the last year in the markets than they did in the past 20 years combined. Mm-hmm. And that is like a freight train just coming through. Even if institutions are unloading a little bit, it's enough money to keep the market going up. Now, at some point, the average investors run out of money, right? But when is that going to be? And that's the big question.
Well, I mean, I'm assuming that a lot of this is because of the central banks just printing money like crazy.
Yeah,
you can't fight the Fed, and boy, 2021 has been a testament to that old adage.
Yeah, and you're so right. I mean, the Federal Reserve, I've gone on record for years now saying that they are the culprit for basically every bubble that we see, right? So in the 90s into 2000s, we saw the collapse of the dot-coms. They came out, they lowered rates, they made lending easy, which created the housing bubble. Then we saw that collapse. Then they came out with even more guns blazing and created this massive flood of liquidity, which we now have this bigger bubble. And every time they do this, it's a bigger and bigger bubble, which is bad because then you get a bigger collapse with that. And then again, they have to come out with their bazookas and just do it even more. I ultimately think the Fed won't exist in their current form down the line because they're going to be blamed. They're going to be the scapegoat of the ultimate demise of the financial system. But again, I don't know when that will be, but you can't, you run your own household. I do mine as well. You just can't print or borrow money on credit cards forever. Eventually those bills come due.
Unless you're the Fed.
Yeah, right. But that even with the Fed, right? I mean, at some point, our country's going to continue to, or at some point, does the dollar start to collapse because of what they're doing? And there has to be some end game. Otherwise, everything I've learned in my life about smart business, it means nothing.
So modern monetary theory is plausible.
That's what it is. I mean, and even politicians now really aren't even, they used to be, you had some pretty, staunch hawks out there that didn't want to run up the deficit. And now whoever's in power is okay with it. But, it's nuts,
and it doesn't matter what side of the aisle. I mean, they're in the game here. So you're pretty bearish on the major markets. What's your view on crypto and also on precious metals, say for the next 3 to 6 months?
So on gold, we had a big pullback this week. I think it's a huge buying opportunity. I love gold longer term. I've mapped it out. We should see a breakout of an inverse head and shoulders by end of year, which should send us back to 2,100, which was a previous high on spot gold. I think ultimately within 2 years, you're above 3,000. I wouldn't be surprised if gold could be a best performing asset in 2022 out there. Crypto, I love the idea behind it. I think that it is the future, but you need to see some of this leverage wiped out of the system. I mean, people are going and using certain platforms to borrow against their money and then reinvest it in more crypto, which then they can borrow against. I mean, there's so much leverage in the system, kind of for stocks too. I mean, margins at all-time highs, people are leveraged to the hilt. That has to wash out at some point. So as much as I like the outlook for cryptocurrency and it being kind of the digital gold for Bitcoin. I just need to see that flush out first, something where we go down to 30 or 20,000. We got to 30 earlier this year. I just was expecting 20, and I still think we'll get there at some point.
Do you have anything that you think our audience should know?
I mean, in general, I think just as a trader or an investor, or a long-term investor, you want to kind of stay in your lane. You want to be someone who learns and kind of dissects when you make a bad trade. Have a little notebook that you write down why that didn't work out. You want to have reasoning behind it. I think that's really, really helpful. And again, be cautious in this environment. It's an environment built like on a house of cards. And, so many people are just going all in on the markets or on crypto. And again, I've gone through many bubbles bursting, and it's not pretty. And it likely will happen again at some point.
Yeah, no, I agree with you. I mean, I remember my days trading, and it was, everyone was just so bullish. I knew someone who had made, I think $7,000 off a $200 stock investment. I'm like,
wow,
just sell at least half.
Sounds like Shiba Inu. It sounds like, did you hear about that with someone who invested? What do they invest? A few $1,000 and turned it into billions. Like,
yeah, it's craziness. And, those people don't take profits.
No, you're right. And Shiba Inu is all the way, it's come down quite a bit from the highs already.
Absolutely. Well, Gareth, I really appreciate your time. It's been a great conversation, and hopefully we can speak again in the next few months as the markets develop.
Yeah, I would love to check back in a couple of months. Absolutely. And thank you so much for having me.
All right, Gareth.